Hello everyone, welcome back to the channel. So today we'll be entering into new chapter called National Income Accounting. Like as we all know, National Income Accounting forms a very important part in both mains and prelims aspective because questions have been asked from this chapter earlier. So let's get into the topic. In this video, we'll be looking into concept of income, uh, what is factor and non-factor income, factors of production, national income, circular flow of income, and basics concepts related to national income accounting. So to begin with, so what is national income accounting? See, national income accounting is nothing but measuring the economic activity of a national economy as a whole, like GDP, net domestic product NDP, GNP, NNP, gross national income, net national income, are few such uh, measures which are used to measure the economic activity of a national income. So, what is concept of income? See, like income is a term which is used to describe the excess of revenue over expenses, which can be simplified as a difference between what you earn and what you spend. Like it's nothing but after, let's say you get a salary of rupees 20,000 and you save 10,000 after all the expenses, that is your income. So that is income. The difference between what you earn and what you spend is the income. See, the United States government defines income as the sum of all financial revenues received by individuals, households, and firms within a certain period of time. This definition, you can find in my notes, which I'll be sharing soon. Next is, what is factor and non-factor income? See, the term factor here means the factor of production. See, there are four factors: land, labor, capital, and entrepreneurship. Okay. See, what happens is, see, these factors of production sell the service to the production units. Okay, like landowner gives their land for production units, entrepreneurship give their ideas for the production unit, capital investors put their capital to the production units. See, what happens is the production units in return pay the price for the factor services purchased by them from the owners, like they pay rent to the land. Production units, factories pay rent to the land, pay interest to the investors, or give shares to the investors. That is something factor income comes into play. See, what is non-factor income? See, there are certain money receipts which do not involve any sacrifice on the part of the recipients, like gift, donation, charities, taxes, fines. These are all the receipts uh, where you don't get any return back, right? Because these in type of incomes, like someone gives you some donation or charity, it just represents a transfer of money without any good or service being involved in return for the receipts. And it should be also noted that national income only includes the factor incomes but does not include the non-factor incomes. You should remember this clearly. Next, let's get into the factor of production. See, the concept of factors of production, let's say, refers to the resources and inputs to produce the goods and services in an economy, like which can be divided into four category: land, labor, capital, entrepreneurship. See, land is very important for production. It's a factor of production. It encompasses all natural resources used in the production process, like agricultural land, forests, minerals, water bodies, everything. It brings into the land. See, land is very important source because it provides the foundation upon which many industries or even agriculture thrives. See, See, a landowner who gives his land for production gets paid back as rent, which is a part of national income because it's a factor income. Next is the labor. See, labor is the most important factor of production because you can have land, but without labor, you cannot produce anything. Like it can represent skill, knowledge, physical efforts, which can be contributed by individuals to create values. Like again, a worker might get return in terms of salaries or wages, which comes again into the concept of factor income, uh, and it comes into national income again. Next is capital. See, capital means it does not include money but also include man-made resources used to facilitate the production like machinery, tools, equipments, even financial assets. See, here the owner of capital gets interest as a factor income, which again comes into the part of national income accounting. Next is entrepreneurship. See, entrepreneurship is a dynamic and often very, very underestimated factor of production because it involves creativity, innovation, and risk taking abilities of the individuals who drive the production process. See, the factor income in this case is the profit. We must know that, under which the national income comes under which the profit comes under the national income, but we should also know that the same entrepreneur might also run into losses, which again comes under the national income. See, there are four types of factors income coming in four different types of factors of production. Landowners get paid in rent, laborers get paid in salaries or wages, capital owners get paid in interest, and entrepreneurs get paid in terms of profit or even losses. This is something of factors of production which are very, very necessary, basic necessary for setting up an industry. Coming on to the next, the national income. See, national income refers to the aggregate value of final goods and services produced in a country during a particular period of time. In India, we call it the period of time from April 1 to March 31. That's a financial year. See, what it does is national income gives a clear picture of the economic activities and tells us about the country's purchasing power and also serves as an instrument of economic planning. See, what happens is when you take the success, the achievement of each year, each financial year, you could calculate what is important for the next financial year and what we must focus for the development of the next financial year. That is what happens during the process of budgeting. See, taking into consideration of the previous years, the budget is focused on what to concentrate for the next year. This makes us planning. National income brings into the planning of budget for an economy. So hope you guys understood this. Now let's go into the circular flow of income. See, the circular flow of income brings in three different types of models: 2-sector, 3-sector, and 4-sector model. We'll be dealing with one by one. See, a circular flow of income is nothing but it reflects how money flows through different sectors of economy and form the basis of national accounts and macroeconomics. So, starting from the 2-sector economy, see, in 2-sector model, it's without the financial market. Like it's assumed that there is no savings in the economy. So what it does is when looking into the diagram, you should find that households spend their entire expenses in their business, in the purchase of goods and services, and every firm spent all the receipts from the sale of goods and services to make factor payments. That is, house gives expenses, pays and buys the products from the firms, and firms in turn pays wages or dividends to the households. This process keeps on going, assuming that there is no income. No, sorry, no savings. So the income formula can be considered as the consumption plus investment. So that is the formula for two sector model. Coming on to the next, the three sector model. See here, the government sector is included along with households and firms, which makes into a three sector model. Here, what happens is government levies taxes on households and firms, and also purchases goods and services from firms, and receives factors of production from household sector. See what happens is, let's say the process of two sector model keeps continuing, like households purchase goods and services from the firms, and firms in turn return to the households through wages, dividends, interest, profits, etc. Okay, this concept, when the government concept comes inside, it puts tax for both buyers and sellers. So what happens is households pay taxes to the government and firms pay taxes to government. So, and again, government purchases from the firms, and in turn so does some social transfers to the household, like people to the below poverty line. So this is something which is what a three sector model is does, like we could say even in ancient days something like this might have been followed, because during that phase the part of the external sector was what not very much so in very many societies. So this might play a role, but still it's very negligent value. So the formula can be said as income consumption plus investment plus government gives the income of the three sector model. So coming into the next, the fourth sector model, this is very important again, I would say, because this is how the current societies run. It's composed of households, firms, government and external sector. See what happens is, as usual, everything keeps going according to three sector model, but only thing which gets added is the exports, the trade happens. Like here again, an economy imports from the rest of the world, and an economy exports to the rest of the world. This is something which happens. So because of which what happens, the formula entirely changes, like the consumption, investment plus government expenditure plus imports minus exports or gives income. See, it can be even positive and negative. If exports are high and imports are less, it can be positive, and if imports are high and exports are less, it can be negative too. So income is based upon that. So hope you guys understood the three sector model. So coming on to the next, the basic concepts related to the national income accounting. So we must again know that these are very basic concepts and form much relevance to the part of this chapter. Starting from domestic territory. See, it refers to the geographical territory administered by the government of India, within which the person, goods or the capital can circulate freely. So you must know what is domestic territory and what criteria forms the domestic territory. For example, Indian embassy, which is located in China, USA or anywhere in the country, becomes a part of the domestic territory of India. But a foreign embassy of China, America, UK, whatever countries located in India, does not belong to part of the domestic or economic territory of India. But still, let's look into what the domestic territory usually comprises. Like 12 nautical miles from the coast, like from the geographical boundary, there are 12 nautical miles from the coast into the territorial waters of that country. That forms the geographical boundary of the country. Again, ships, fishing boat, or aircrafts operated by that country, even when they are in the foreign land. I would say Air India formerly. That is something uh, that was something operated by India, even though it was going from to and from India, to and from India. Again, embassies, consulates, and military bases in the foreign countries also belong to Indian country if it is operated by India. However, we should also know that private properties or companies which are operating in foreign land is not considered a part of domestic territory. The sum of all factor incomes produced in a domestic territory of a country gives us the domestic income, and it does not matter about the nationality of the person, but only the domestic territory matters. Like, we should understand here that even a foreign country can produce their goods and services here, and their factor incomes are also added to the part of the domestic income. But when an Indian company produces something abroad in other countries, that is not added. So the nationality um, or the nationality of a person or the person who owns the production process does not matter. If it is in India, it is counted into the process of domestic income. That is the domestic territory. Next is household savings. See, we save through many ways: currency, bank deposits, debt securities, mutual funds, pension funds, insurance and investments in small saving schemes. So you should know that when we all do above savings like in currency, bank deposit, debt security, mutual funds, pension funds, when you all add together, we get the gross household financial savings. But when we deduct the liabilities such as loans from that gross household financial savings, we get the net household savings. So we should know that when we add all the household savings, we get the gross household financial savings. When we reduce the loans liabilities like loans as interest which need to be paid, these things, when we reduce from the gross household financial savings, we get something called net household savings. That is the final in household savings which a household holds. What is market price? See, market price is nothing but a price which a consumer pays for the product while purchasing it from the seller, and it includes the indirect taxes and excludes subsidies. Let's say and a person goes to the market and buys tomato for 50 rupees per kg. See, it includes the indirect taxes too, like taxes to transportation, GST, everything gets included. That is what something happens. But the same thing, same person does not is buys 50 rupees per kilo for tomato, but it excludes subsidies. Like, farmer might have used some subsidies to produce the tomatoes, but he does not include that, but only includes the indirect taxes. Next is the factor cost. The factor cost is nothing but it refers to the cost of factors of production which are incurred by the firm when producing goods and services, like land, labor, capital, entrepreneurship. Okay, a farmer needs land to produce tomato, and a capital to buy the seeds, entrepreneurship, labor to do the idea, and entrepreneurship to in case use some innovation to bring more harvest. See, it excludes the indirect taxes but includes the subsidies received. Like, farmers might get 10 rupees or 20 rupees subsidy for producing 1 kg of tomato. This is something which we must be note. Like, in market price, indirect taxes are included, but in factor cost, indirect taxes are excluded. In market price, subsidies are not included, but in factor cost, subsidies are included. So this is something like the factor cost formula is nothing but market price minus indirect taxes plus subsidy. Now let us look into the nominal price. See, the market price of any good or service in a current year is called nominal price or current price. Inflation also plays a major role in the current market price as price gets adjusted according to inflation. Like let's say in 2024, the price of tomato is 50 rupees per kg, and it gets adjusted to inflation every time. That is something nominal price or current price, and it gets adjusted according to the inflation every month, every week, or every day too. But base price, next one, base price is a constant price. See, it's used to compare the decrease or increase in the year. It's calculated with reference to a particular year, which is used as a base year. The market price of any good or service in a base year is called base price or constant price. So what it is like, let's say this is 2024. As I said earlier, the tomato price is 50 rupees per kg. The government of India sets 2011-12 as the base year. During that phase, 25 rupees per kg of tomato was sold. 25, it was 25 rupees for 1 kg of tomato. Now what is the price of tomato in 2024? It is again 50 rupees. So there has been 25 rupees increase in the price of tomato. So base price is used to compare the increase or decrease in income, and it is calculated with reference to a particular year, which is usually refers to as base year. Next is depreciation. See, it's nothing but the conception of a fixed capital. You might get confused. What is that? See, when you buy equipment, automobiles, tools, machinery, what happens is after every year the tools get depreciated for a certain amount, certain period, certain amount. So, which might be due to wear and tear, accidental damages, or obsolescence, whatever it may be. So the Ministry of Commerce and Industry will decide the rates of depreciation every year for particular machinery, product, tool, or whatever, automobile, everything. This is depreciation. So what is capital output ratio (COR)? Say it refers to the amount of capital needed to produce 1 unit of output, which also clearly reflects in the level of efficiency in an economy. Look, to make it clear, let's bring it here. If you want to produce 1 kg of tomato, how much money would you need? Like let's say you need 20 rupees to produce 1 kg of tomato. That is capital output ratio. It refers the amount of capital needed to produce 1 unit of output, which shows the efficiency in an economy. So to know if the capital output ratio is high, like let's say if the same tomato is produced for 40 rupees per kg, that means more capital is required to produce, and thus there is less efficiency in the economy. But if the same tomato is produced for 20 rupees per kg, the efficiency is high and less capital is required to produce. So that is something during when the capital output ratio is less. So what is incremental capital output ratio, ICOR? So it's again nothing but it refers to the additional unit of capital needed to produce 1 additional unit of output. It's very simple. Like in the capital output ratio, we saw how much it costs to produce 1 kg of tomato. In the incremental capital output ratio, we see it shows how much money is needed to produce 2 kg of tomato. So that is something, the increase in quantity and how much it will increase in the capital. So it brings in the ratio of that. So that is something incremental capital output ratio brings in about. So yes, this is for today's topic, today's lecture. So hope you guys understood the concept today. Do hear the lectures, listen the lectures, try to understand the topics, and kindly comment your doubts. We will come back with, or we will continue with the national income accounting in the next lecture soon. Thank you.